Today, this evening, this is a topic that kind of spends some years kind of pulling it together. I'm from Miami County. I grew up on a grain farm in Miami County. Um, my family farms a little over 1,000 acres. And so grain marketing is something that is always on the mind, but it's not necessarily an easy subject to learn. And it's constantly, I don't know if changing is the right word, but you got to keep up with it. And so I'm going to kind of show you some different ways to kind of think about that tonight and hopefully make you a little bit more at ease because this can be very stressful for producers. Um, and we'll kind of go through and talk about why and how we can kind of mitigate that stress. So we're going to begin with asking kind of some critical questions about marketing. It's good to kind of know where we are so we can kind of have a map to where we want to get to. For your farm business, we want to kind of clearly know what you're trying to achieve as well. It's more than just kind of, well, what's the price today? Let's sell. So to do that, we're going to be able to examine the risk capacity of your farm business, because that's really going to help you determine, at least in part, your marketing strategy. It's going to be one factor that's going to let you know, how aggressive or how conservative do you need to be in your marketing plan. So to begin with, we'll kind of look at how do you put a number and how do you figure out what your farm business risk capacity is. And to do that, we're going to need to determine what your price needed per bushel to break even is, which is often referred to as your cost of production. So we're going to kind of learn how to utilize that cost of production to put it into your as a pricing guide in your plan. There's a little bit of homework to find that number, but I'm going to show you a couple different ways you can do it. But it's also helpful to know where it can kind of like identify areas in your production that where you might be able to cut costs. For example, if the numbers kind of come back and you're spending a lot amount on pesticides, for instance, you can kind of begin to ask yourself like, well, why is that? Or maybe you're spending a lot of money on seed. And I'll show you ways that we can kind of find out, is that normal? Is that not normal, sort of speak? And you can kind of work through that and think about some different ways that you might manage things to kind of reduce that cost. And not every farm has the same risk capacity. A producer that is like 30% owned ground, 70% rented ground, they're going to have a different risk capacity than a producer that is flip-flop, that's 70% owned and 30% rented. Or a producer that has an off-farm income, or a spouse with an off-farm income. A producer that's only 500 acres versus a producer that's 1,500 acres, they're going to have different approaches to grain marketing because they handle risk very differently. My husband and I only farm about 80 acres. We kind of just do it on the side for fun, right? So we kind of manage our risk a little bit differently than my dad, who farms over 1,000 acres. So a little bit different, strictly just because we have a different cost of productions and different ways to approach that because of that. So a grain marketer's plan, it's helpful to have a plan, because if you go out there willy-nilly, it's just not a good thing. So it's better to have kind of a roadmap of where you want to go. And your plan is going to be influenced by a couple different types of risk. It's yield risk and price risk, which those things can be influenced by weather, trade, and many other factors year to year. So one thing that is kind of different amongst everyone is your risk tolerance. How that is going to affect your marketing plan and your management plan. Are you one that likes to play the lottery, or are you one that likes to play it safe? So what we're trying to do here is kind of move you from a speculator to a risk manager. A speculator is only going to look for the highest price of the year. They might read magazines or follow market trends, watch the news for information on trade. You might subscribe to a marketing analysis newsletter or other ways to be able to predict what the market is going to do. And none of these are bad practices, but this is solely what the speculator relies on to market grain. They focus on those day-to-day movements. They can potentially drive themselves a little crazy with the what if scenarios. If you try to calculate, if I would have sold yesterday and not today, I would have been better. And so that can kind of be a little bit of a drawback. But speculators view price as something that's separate from their business, and they're extremely focused on short-term profits. So kind of to use a baseball analogy, this group is focused on hitting home runs every time they step up to the bat. And we know from history that doesn't really happen. So what we're trying to kind of move towards is that risk manager. So a risk manager is interested in making a profit. And who isn't? Everybody is, in the business to keep it around. If the business isn't around next year to farm, what's the point? So this person is focused not only on the survival of the business, but the growth of the business. We can't afford to do kind of business as usual in this changing climate, with the markets changing so much and so much volatility and even weather patterns kind of changing. So we do have to be able to kind of pivot and grow in some way to kind of maintain our viability and competitive edge. So a risk manager builds a marketing kind of into the business. It's part of the business. They realize the value of having that plan, and they know what their cost of production is. They know what price they need to cover the costs that they have inputted into the product. So again, their biggest focus is on long-term, and they're not kind of dwelling on those what ifs or those lost incomes lost. I put by not selling high. So I realize that part is kind of hard to do, but as we mentioned before, if you have a plan and you can kind of adjust it a little bit at any point of the way, as long as you're covering your costs, you're probably going to live to farm another day. So this risk manager really focuses on kind of getting singles and doubles and maybe occasionally a triple, but not necessarily a home run every single time. So a lot of people might focus on just what is the corn yield and what's the price done historically. So this is a graph of the last like 57 years. And overall, we can basically get from this graph, when yield goes down, the price goes up. It's not always the case. There's a few outliers there. You see kind of right here in the early 80s, here in the mid 70s, and then between 2010 and 2012-ish, right in there. The takeaway is, though, that you can't really bank on this, what we call a natural hedge, to protect you against production risks. So you need to be a little bit more strategic and thoughtful about your marketing plan. And we could do similar charts like this for wheat and beans, but for time's sake, we're just kind of focused on corn here. It's very similar. So there's a lot of things that will focus your kind of shape your marketing decisions. It's going to be, how decisive you are as a person, and what your past experiences have been. If you're a person that doesn't like stress, you might try to make some easy decisions. What your philosophy is as well. So it's not, what we should focus on when marketing your grain is that, your goal should be not to make bad decisions, but you can't be awesome every single time. And a lot of this has to do with your financial cash capacity. If you're only selling when you need the cash, you're probably going to be worse off overall. And the main reason that one should be careful about relying on any kind of like outside marketing advice, because there are firms that do this, right? They offer to market your grain, take the stress off of you. They'll do it for you, but they often don't know how much risk your business can afford. So farms with strong balance sheets can afford to take more risk and kind of swing for the fences, so to speak. But farms that don't have strong balance sheets, they're going to need to be, farms that don't have strong balance sheets, whether they're maybe like a young farmer or those that have really expanded aggressively, they might not be able to afford on trying to get those home runs. They might be focusing on like, we need this predictable income, these singles, these doubles, for a baseball strategy or a baseball analogy there. But for the most part, these marketing firms don't really ask, what your financial capacity is. So that's just something to kind of consider. And they don't often tailor the advice to your local area. So to find out how aggressive you're going to be able to be is to look at your cost of production and how you can manage that risk. So kind of talked about some of those risks, and there's some tools out there to, if you don't know how risky you are, there's some tools out there. The University of Vermont has a good one about risk tolerance, especially when it comes to grain marketing, that you can find online. You can do it online. but we'll kind of examine what your financial position might look like and see how that is going to affect your risk. So we're kind of, as we build our marketing plan, you kind of have to evaluate different management strategies on how they're going to affect risk. So for example, if you price or you sell 10 contracts on the Chicago Board of Trade, did you reduce your risk or did you increase your risk? And what if you bought calls on, so over the next our time frame here, we'll discuss how we can kind of maybe associate them back to whether or not those increase or decrease our risk. So one tool we can use to evaluate your farm's financial position is your balance sheet. So it should always be calculated on the same day to provide some consistency. Most people use December 31st, just as to kind of the final picture of the year. But it's going to speak to all the assets that the business owns and the financial obligation the farm has to others. Sometimes it might be known as the net worth statement, but this can provide a way to measure your farm business growth, your liquidity. So how fast, oh, I got recording, whoops. Sorry, I lost my place here. So it's going to tell you a lot of things about your growth, your liquidity, how solvent your business is, and what kind of risk that you can bear. So current assets, that's going to be the short-term health of your operation, particularly in times of low prices and losses. You're going to be interested in that number. These are the ones that are the assets that are owned by the farm that have value, include things that the farm uses to produce the products that they sell. So things like cash, grain and feed inventories that you might have, any prepaid expenses, machinery, equipment, buildings, maybe farmland in there too. And liabilities, on the other hand, are going to be what your farm owes to commercial lenders and vendors or private individuals. And those are usually due within 1 year. There might be operating lines of credits or, accounts payable, like if you owe the feed mill or the seed company or a fuel supplier or something like that. So again, having all these pieces together is crucial. A farm can have a lot of assets in land and equipment and profitability, but they could be short of working capital if the assets can't readily be converted into cash. So a positive working capital is really required to ensure that your farm is able to continue its operations and that it has sufficient funds to satisfy both that short-term debt and upcoming operational expenses. So this is another tool that we kind of put in there to see whether or not you have or what your risk capacity is. If you don't have much working capital, you're going to need to be more frugal with your decisions and protect your working capital. If you're short on working capital, you might think about ways to increase it. So that could be, net farm income, after taxes, your personal investments, if that be maybe like off-farm employment, and things like that. This is really the number one cause of bankruptcy in farms, is the lack of liquidity, in that maybe we've had some good years, so row crop growers haven't really had to think about this for some time. But if we can kind of get to that per acre break even revenue, that's going to really kind of help us decide what we need in terms of our market plan and when would be a good time to sell, because you need to cover those costs. So really, before you plant anything in 2021, you should know exactly what your current assets are, your liabilities, what your working capital is, and even not just what your working capital is, but what it is per acre. You can even do it like that. And some people do working capital per bushel, but that's a little bit more variable. So we like to talk about it in terms of acres, so because you can know those up front, and they're a little bit more steady. So cost of production, this is the total cost of your seed, your fertilizer, your chemicals, any other expenses that you might have, any custom rates that you have to, cover, any drying costs, if you have any interest or equipment costs, and then land costs. So things like rent or taxes or something divided per acre in the production of that crop. So maybe some of you don't know your cost of production. This is basically what it takes, how much money it takes to grow a crop per acre. And it's going to take into consideration all that. I mentioned that some people prefer it in cost per bushel than acre, but we can see some advantages and disadvantages. Like I said, the acreage you can know earlier. It can be modified a little bit, but cost per bushel is only going to be known at harvest, for sure. Both are important. Both can be estimated a little bit in advance, but we do kind of tend to go a little bit more towards the per acre. There's a couple different ways. We have some budgets for most of the crops we grow here in Ohio, corn, soybeans, wheat, and lots of others, on our farm office website. So it's farmoffice.osu.edu, and it's under the farm management tab. And that's what Barry Ward's budgets are. He comes up with those. He's the leader of our production business management department in the college, and he leads our tax schools every year. So he puts together those and updates those, and it's an Excel file that you can just plug in your costs, and it calculates that number for you. Of course, you could keep actual records by enterprise or by location. We find that people do not calculate real numbers for labor and management and equipment. And if you're a full-time operator, even a part-time operator, your labor and management, there is a number to that. And so we'd always advise people to put that in there. There's a couple different ways to do that. You can have your own costs. Maybe you've decided, what your time is worth. There are the National Ag Statistics Service has some kind of averages, but that's kind of on a national level. But it's somewhere to start. So you got to plug in somewhere. When we did this series, so this is a 6-part class that I put down into 1 part tonight. So it's a little bit of a challenge, but when we did this about 2 years ago, kind of in about 5 different counties, found that most people did not plug in a number for labor and management. And they're really selling themselves short, because that is a real number. And equipment. They don't put anything in there for equipment. And that's a real cost. You're going to have wear and tear on equipment. And if you don't have that number, then what have you saved to replace that piece of equipment when it needs to be replaced? You can calculate a 5-year Olympic average. That's where you take some people take 7 years and then take off the highest and lowest. Either way, you can take off the highest and lowest year, basically, and average what you have left, and that could be your cost of production. But then you could use one of these methods, but then also adjust according to market outlook for inputs. Sometimes we have some data that says fertilizer is going to be really high this year, so you could kind of adjust it for that. We also have a large database of farm financial and production benchmark information. So these are people who have worked with usually an OSU professional here in Ohio, and they've plugged in all these numbers, their whole operation, and it does is it compares you to other farms of your similar size and your similar area, so that you can see how you're doing compared to kind of your peers, as a kind of a measurement of are you spending too much on pesticides compared to your peers, and is there a reason for that? And are you spending too much in fertilizer, and is there a reason for that? Things like that. So this is from a couple years ago, just some examples of what a cost of production might look like. This is from FINBIN, so this has data points from states closest to us. So these for crop farms only, but it includes Illinois, Michigan, Minnesota, Missouri, Ohio, South Dakota, and Wisconsin. This program is really big in Minnesota, so there's a lot of data points from that. But we can begin to kind of see an idea here from this. So, on corn ground that you own, the group median out of 17 producers, their average cost of production was about $4.10 rather. So you can kind of look at that and think about, maybe that might be a good way to help cost of production. We have in the Southwest Ohio, we have a professional that does that for us, David Jenner. So I've got his information right here. If that's a program that you might be interested in, I would reach out to jenner.12@osu.edu, and he can help go through that and help generate this cost of production for you. Skip that. There might be this was an example of where this person's seed cost was really high, so it's in the 10 to 20 percentile for the highest of their peers per se. So this person might think about cutting back on their seeding rate as a way to maybe save money. And we've got some really great information about that in eFields. It's our on-farm research report that comes out every year. So it's grown every year. I think last year might have been like 90 some trials that were in it. And there are a lot of information, particularly on seeding rates, as we were just talking about that. But a lot of county educators, worked with producers, did seeding rate trials, and then put them all together so you can kind of look at usually a county near you and an operation that might be similar. Now we're going to move into what we call the marketing matrix. So let's think of an example farm that we're going to use today. It has 180 bushels per acre corn, and that's based on the last 5 years of production. In poor years, the yield drops to 140, but in a good year, it bumps up to 200. And we're going to use just a price at planting for that corn is $4 a bushel. And we're going to take a look at an example of what if the national price goes to $5 if they have a poor national yield. And then the price would go to $3 if it has good national yield. So that's that whole, if yield goes down, price goes up. If yield goes up, price goes down. So that's what we can see right there. And we'll look at that a little bit more. And we're not making this up. Basically, we have data that says this graph kind of shows the relationship between the price of corn and how much off the trend the national yield was for that particular year. So in most cases we can see that the lines kind of move in opposite directions, indicating that the price typically decreases with a larger crop and increases with a smaller crop. And this is important as we think about grain marketing strategy. So when yield increases, there's more availability to satisfy demand, so the prices decline. And during low yielding years, grain might be more scarce. That creates more competition for that grain. It drives the price up. So we have data many, many years to kind of support that. Not really theory, but support that. So this marketing matrix, it's designed to help you kind of think about different marketing scenarios and what your risk and risk management tools might be. So there are 4 situations that can occur that affect our revenue. So the first is a good national yield, which drives that price down to $3. The second is poor national yields, which drives the price up to $5. The third and fourth are dependent upon local conditions, which do not affect the price, but do have an effect on your revenue because it determines how many bushels you have to sell. So the third situation is a poor farm yield that results in few bushels. And the fourth is a good farm yield that results in many bushels to sell. So this combination between the national yields and the farm yields will determine revenue. So we look at each one, we look at each combination kind of individually. So let's look at our first scenario. So we have the, can you see my mouse? I don't know if you can. The first scenario, the national yields are good, but farm yields are poor. And this is a really undesirable position to be in because prices have been driven down by national abundance. But you've got very few bushels to sell because you're poor, you have poor local conditions. And this is the type of situation where insurance comes in. So whether that's yield insurance or revenue protection, you can help cover your costs. Also, what might be something to consider here is if you over marketed your grain, you might have to buy out some contracts, and that's not where you want to be. That's going to be a penalty associated with that. And revenue protection may help you if you do that. So as you're thinking about marketing your grain, you have to look at what were your low yielding years and what are you comfortable marketing in that scenario. In the second scenario, your farm matches with most of the nation in having good yields. So while prices are low, you have a lot more bushels to sell than in the first scenario. So depending upon how low prices are, revenue insurance might kick in. So if you had paid more attention to the market signals, maybe could bushels have been sold earlier at a higher price? Another option is downside protection, purchasing minimum price contracts so that you can guarantee a certain revenue would still leave the option of selling at a higher market price if there is kind of a rally in the market. But it protects against future price decreases. So if prices are at or above a break even, this is a good tool to ensure that you cover your costs. Now, what happens when we have poor national yields? Poor national yields and poor farm yields. So that's the top left box, because I'm not sure if you can see my mouse. So prices are driven up because there's a shortage. In this scenario, the farm yields are also poor. So crop insurance is likely going to make a payment in this scenario. If you've oversold grain, though, you're going to need to buy out contracts. And this is an important caution when marketing grain. If you have bushels left to sell, you'll get a higher price, but is it enough to make up for those losses in yields? And the fourth and final scenario is where every farmer wants to be every year. So that's the bottom left scenario here. This is where prices are high because we have a low national yields, but your farm was kind of in a garden spot and it produced, 20% above the average yield. And this is the only thing that would make this scenario undesirable is if you sold too much too early. So hopefully with the high yields, you would still have bushels left to sell. But that's all about, how much do you sell and when? That's kind of what we're trying to look at here. So outlook is important to determine prices. So we're going to look at, well, what will happen if prices go 10% increase or 10% decrease with yield? How's it going to affect my bottom line? And looking at it as a percent of normal based on yields of that time. So what information can you gather to make a more educated guess about how the prices are going to be affected in certain situations? So what can you do to help make this grain marketing plan go a little bit smoother, given that those prices and yields are determined on a national level? So outlook is most important when you're determining whether what's going to happen to prices with an increase, 10% increase or a 10% decrease, and then making that determination for your own farm and what's good, what are poor yields, that's up to you. And it really should be based upon the history of your field, which you should have if you keep records. If it's a new farm, you might be able to get records from Farm Service Agency so that you can help make that decision. Also, some of your fields might be a little bit more resilient than others because they're not consistent. Some fields, because of where they're located or their soil type, they might not be able really to be able to withstand something like a drought, while others can have they can have a significant swing in production. But others might be in an area that seems to do pretty average. So it can happen. And what happens in weird years where we have a drought like in the late 80s or too much rain? What happens with all those situations? Of course, we can't control those, but definitely comes into play. So let's put some dollar scenarios, dollars to these scenarios, so we can kind of envision how they might affect your balance sheet. So what I did was I took that, so for the top left, the poor farm yield and the poor national yield, I took that 140 bushels. I said that's what about like a poor yield would be on this typical sample farm. I took it times $5 and we get $700 an acre. Similarly, I did what if we had a good farm yield and a poor national yield, that 200 bushels an acre at the $5 would be $1,000 an acre, and then you see the 420 and the 600 on the other side. So what situation could you survive? If $720 is our revenue in an average year, we've got three of the so that's the average. 720 is our revenue in an average year. But 3 out of the 4 years, you're probably going to be okay. Now, what about that first scenario we looked at when the revenue drops to 420? Can your farm withstand a $300 cut per acre? That's a significant cut, right? So we need to kind of look at these numbers and think about these. And it's probably one of the reasons you might be taking the class. How can you prevent that from happening, right? and hopefully we'll get some perspective as we go along here. We would recommend you create some sort of your own matrix, consider what might be reasonable high prices and low prices given the outlook for this growing season. So take into account what prices we've been seeing, kind of plug those numbers into your own matrix, and then determine, what's the low and high of your farm yields and what's the probability of those. And I'll give you those in a second here based on historical data. We've had a lot of good years in the last few good yields in the last few years, except for the prevent plant years, most recently. But we can use some averages and the history of the variability in your farm yield to determine what that percent of low and high yielding years are. JT, I was going to ask you, I noticed the National Ag Statistics Service didn't have any data for 2019 as far as what your yield history was. Was that because y'all had so many prevent plant acres?
I don't know. I'll have to look into that.
I thought it was interesting. I was trying to calculate like a 5-year average for Butler County, and it didn't have any data for 2019. So kind of complicated.
Yeah. Go ahead, Brady.
I saw that as well. I think so. I didn't really see a reason, but I think it was because of the prevent plant numbers.
It's kind of what I thought. So, and that might be some of the producers on the call. So if you have prevent years, you're going to have to either go back 6 years and do a 5-year average, or, do it only from 4. So, but you can use those numbers as what your historical yields. You can find that. Minimum revenue really matters in situations where you might be a newer beginning farmer, or if you're a heavily cash rented farmer, you don't have a lot of wiggle room sometimes. So that's going to help you identify, this matrix is going to help you identify, what you might expect as a minimum revenue in those years, and it can better enable you to come up with a plan so you can mitigate that. So for each scenario, there are strategies to take in order to mitigate risk or take advantage of the situation. So for the first situation, we've got yield or revenue insurance can protect against a total loss. If you aggressively market grain, you must be careful not to oversell, or you might have to buy out your contracts. These contracts will likely be higher in price than the contracts you sold. For the second situation, yield insurance is not going to come into play, but revenue insurance would make up for those low prices if the yields are not high enough to do so. So opposite of the first scenario, did you sell enough? Did you sell enough early on? And this is similar to 2018, where yields were significantly higher than expected, but prices were low during harvest. So some farmers who market grain ahead of time who thought they only had 75% of their marketed ended up with only about 50% of their total crop sold. So some grain contracts also protect against price decreases, and there may be an option to keep the price open. So you can potentially have a price rally but protect against future declines, and we can kind of discuss that a little bit later. The third scenario of high prices, I'm sorry, it's supposed to be high prices, few bushels. If you do the high prices, few bushels, these numbers came in the wrong way I was talking about. I apologize. The third scenario, where that top left there. So high prices and few bushels. So this is another one where crop insurance is going to help, and yield protection will likely pay out with few bushels. So depending upon whether the high prices can make up for few bushels is going to determine if revenue insurance makes a payment. So again, did you market too much too early? You have to buy out contracts. If you end up with bushels left to sell, you'll likely be in good shape with high prices at harvest. And in our last scenario, insurance is not likely going to make a payment given the revenue coming in. It's not going to be needed. And like scenario 2, did you sell too early even at a lower price? So with good yields, you're likely to have some unmarketed grain where you can take advantage of those high prices at harvest. So the percent of time that these happen, typically we've seen this kind of scenario. We've seen about 20% of the time we have high prices and few bushels. 5% of the time we have low prices. Low prices and few bushels. And high high prices, many bushels, most of the time, we have those. Our highest and lowest revenue situations occur the least amount of time, if you'll notice. So 5%, 5%, 20, and 70. So we can put our numbers that we had previously to those to find out what our cost might be and what our average income for each situation might be. So in our example that we had earlier, this is how we would do it. We would come up with an average about $631 per acre. So this is a number you can use to see whether or not that's going to cover your cost. Of course, that we don't take into account with this number, particularly, if you might have insurance payments or other payments that might help as well. Sorry, this wasn't supposed to show up. We have yield protection and revenue protection. So those can help in certain situations. Farm level insurance, if we have high prices and low bushels, you might receive a payment at, an 80 or 85% levels for yield protection and revenue protection, but there are going to be no payments when we have a high prices and many bushels. So using this is kind of an interesting way to kind of determine whether or not you're able to cover your costs if this scenario should happen. You can kind of do those calculations where we're going to get no payments when we have high prices and low bushels, but then we're only going to get a portion, for the other times. If you're interested in crop insurance and kind of what that looks like, there are a lot of different tools out there that can help you compare the different types of crop insurance and what their premiums are. One is this farm.crop insurance that the University of Illinois has. And then there's a couple other calculators as well that are pretty helpful. So let's move into basis and contracts. And JT, I can't see the chat. So if there's been any chats, let me know.
You're okay so far.
Okay. Just realized I couldn't see it. So what is basis? So basis is that spot price minus a futures price. So the spot price is the price that we would have for immediate delivery. This would be, you're going to sell it today. This is what they're going to give you. A futures price is the delivery price of a futures contract. So we have what's called basis, which is that spot price minus the futures price. And basis occurs because of local supply and demand. So if a local elevator needs grain, it's going to raise the basis. If it's filled to capacity, basis will drop. The local elevator should have informational advantage if they know what the local crop yields are. If farmers know the historical basis trends for local grain buyers and the cost of trucking, they're going to be better prepared to store or better prepared to market any stored grain that you might have. So this occurs because of the local market. You can have some informational advantage if you are with local stuff, and we can look at historical basis to kind of get a better idea on how to market stored grain. This graph shows what a cash bid for local grain buyers. So this happens to be kind of a little bit north than you all at Dayton and Greenville and Marion and Urbana and Lima. But these are some examples that we had when we kind of taught this class last year. But the graph shows this local grain buyers for me. The future price is if we have a 354, that was in August of that year. So the basis is the difference between that cash bid and the future. And you can see we have some positive basis and others have a negative basis. Transportation costs have to be taken into consideration when you're deciding what's the most economical place to sell your grain. So the locations in this example are sorted from highest to lowest. So the closest location actually came in second to this area. We were kind of using Urbana as a hub there. Because the basis is negative 11 cents, or under by 11 cents. There are some, if you're kind of thinking about, well, what is it? How do I calculate my hauling cost? We have custom farm rates on that farmoffice.osu.edu that you can kind of look at that as a way to determine how much it costs to haul your grain, to put a number to that. So for farmers, but who haul their own grain, though, if you're only considering fuel cost, the closest location comes in almost last. And it doesn't account for wear and tear and labor, of course. But if you're hauling yourself, your time might not be as valuable during the winter as it is in spring and fall. So you kind of have to take into those considerations. Thinking about basis. So looking at basis from a historical perspective, we can kind of pick out some trends of when the basis usually increases or decreases. So one trend we can pick out from the last several years is an increase in mid to late summer, and then a drop off in September when harvest starts. So this makes sense because a local elevator does not need grain, and they're going to decrease basis. And this tells us that we need to lock in basis prior to September to avoid a decrease. And we can use historical trends as another tool, for your grain marketing decision making. So this is a lot of information to look at to figure out when to sell corn and beans. I was talking with my coworker today about what other profession do you know that has to look at all this stuff to decide when to sell to be able to get their paycheck. So it's not the easiest thing. It certainly just doesn't show up, direct deposit without thinking about it. But corn basis reacts similarly to soybeans. There's an increase right before harvest and then a sharp decline at harvest when harvest begins. So it tends to have a greater increase through the winter months than soybeans does, though, for corn. This is a pricing decision chart, which kind of guides us towards which marketing tools make sense in different scenarios. There's a lot of marketing tools you can use, as I've put up here, and we'll kind of look at each one of these and what we do in these situations. So based on what we think basis and futures are going to do, we may market grain differently. So continue to keep in mind that your cost of production is the cornerstone in this whole decision-making process. Expected change is based on educated guesses, not what you want it to do. So make sure you're looking at the outlook, you're looking at different sources to figure out what do you expect basis to do based upon yield, based upon weather, based upon just looking at the market. What is it going to do? These expected changes could turn around in a quick day, or a couple months could be steady increases or decreases depending upon the situation. So it could kind of change. So what's the best grain marketing strategies when basis is weakening and futures are increasing? So this situation is caused by a worldwide need for grain, but not a local need, or maybe transportation may be an issue. So if the US has a major drought, but Ohio is a garden state, local buyers will likely weaken the basis as they fill up during harvest, and the futures price continues to increase as the national shortage becomes evident when harvest comes closer. There could be some competition, though, for transportation. North Dakota kind of comes to mind. They had very low basis because of the oil boom that tied up the railways and the elevators. They couldn't move grain. This is not really likely in Ohio with our access to either rail or water or truck, but it's not necessarily impossible. So we have a pretty good transportation system that hopefully that wouldn't happen, but places like North Dakota are a little bit more limited in how they get grain out. So if we have a weakening basis, but futures is increasing. So this scenario might occur right before harvest during a low yielding year. The local elevator can only take so much. So basis is going to decrease, but that futures is increasing as the yields are lower nationally than was expected. So a basis contract typically sets the quantity, the delivery period, and the basis price, leaving the futures price open to establish later. So the contract may specify which month the futures price will set, and this allows farmers to take advantage of a strong basis, but keeps the futures price open to price rallies. Now, there's no guarantee the price is going to rally, and you don't want to pay storage. Futures, they could go up, but to protect against a turn downward, you're going to lock in that minimum price plus the basis, since basis is expected to decrease as well. So typically the minimum price, delivery period, and quantity are set in that contract. And in a couple years ago in this kind of that summer, fall of 2018 for soybeans, a local elevator was recommending this because there was a concern about the prices decreases if South America had a good soybean crop. So not only do we have to worry about nationally, we have to worry about other countries as well, South America being a big producer. So if the tariff issues at that time were resolved, there was a lot of potential for price increase. So adding a maximum to the minimum price contract is usually done to make it more affordable. So this is an example to show the benefit of locking in basis when it's expected to kind of widen. So it does, but it doesn't protect against future price decreases. So minimum price contract, though, would protect against decreases in the futures market, but likely come at more cost here. And you can kind of see this example. So on August 15th, the basis was under 20, December futures were 350. You could do an established basis contract for 20 under. You see over here on October 15th, the basis was under 40. December futures were 370. So you could sell at or you sell for 350, you could do a cash sale for 330, and you can kind of gain 20 cents if you do it that way. So what actions do we take? When does this occur? When does basis go down and futures go down? This is a common scenario going into harvest time when there's a lot of grain available. It also occurs when large harvests are expected for, or if there's, a tariff war going on. Another situation that could weaken the basis, regardless of the futures price, is when an ending destination temporarily stops accepting grain. For example, large percentages of the U.S. soybeans leaving for China exit out of the Pacific Northwest ports. When the market temporarily stops, a reallocation of the U.S. supply chain happens, causing basis in the Dakotas to weaken and then spread throughout the corn and soybean belt. So we can have that situation as well. So forward contracts might fix futures and basis price for future delivery. And this allows you to lock in a price ahead of time of an expected drop in the market. You're expected to deliver the amount in the contract. So when marketing ahead of harvest, it's important to remember not to oversell. There's some advantages of this. You can capture that carry in the market earlier. You know exactly what the price is. The contract can be for any bushel amount, 500 or several thousand. And it ends in delivery of that product. Another way is a cash sale. So cash sales are a specific quantity of grain at the current price. So you're not expecting markets or basis to improve from today. So there's no reason to do a forward contract. You think it's going to stay the same. You know what the price is. There's no storage costs associated with it, no fees, and it ends in delivery. It's all good. That's another option to take. What happens when basis increases and futures decreases? And when does this occur? Grain markets decrease when there's a surplus of grain available. So remember that basis is local. So it depends upon when local elevators and ethanol plants need grain. So in Western Ohio, ethanol plants, they're likely to increase basis throughout the year as grain is needed. Elevators may increase basis when the Chicago Board of Trade price decreases, especially if they believe prices are going to increase, so they can sell it for a profit. Another option, when the basis is strengthening or increasing and futures are decreasing, you might consider a hedge to arrive. So with hedge to arrive, you can lock in futures price and basis remains open. The contract is with a specific company, so you cannot take advantage of any kind of spikes to other locations, basis spikes at other locations, so you're kind of fixed in. This is the exact opposite of a basis contract. This scenario might occur when the futures price to favorable with the current delivery location, so doesn't need any grain, so basis is low. And using historical basis trends are even better. The historical basis trends of the company you're contracting with. You could contract the futures price for delivery when you expect basis to be improved. So this might be a good option for post-harvested grain that is unmarketed. Basis is historically very low at harvest. So if the markets don't look like they're going to improve, locking in that price for a future delivery when you believe the basis will strengthen being options. This also requires enough on-farm storage to hold the grain until delivery, so that's another thing to consider. So a hedge to arrive example. So on May 15th, the current December futures price is $3.70. The current forward price is $3.55. Set the basis in August. You deliver corn for $3.70 in December versus the $3.55 with forward contract. And this is your contract using the December hedge to arrive, and the basis narrows to 0 in August. So in this, another scenario that might happen is that basis and futures are expected to increase. So this is a situation, or it's caused rather, when there's a expected worldwide and local shortage of grain. Maybe there's predicted bad weather in one of the major corn, soybean, or wheat producing regions in the world, or maybe tariffs have been lifted. So this might happen in those situations. So we have here that we have delayed pricing might be an option if you do not have any storage for this scenario. It's not the same as storing grain in an elevator, as ownership passes to the buyer upon delivery. So the delivery period and the service charge, if there is one, and the date the pricing will be set are determined in the contract. Basis and futures remain open until the period noted in the contract. You can take advantage of market and basis increases, but are also open if it decreases or weakens in price. Some of this can be mitigated with storage and put options. That's kind of like a higher level discussion, I would say, that you'd have to wait for part 2. So example of this, a delayed pricing example, the harvest price might be $8.60. At January 12th, the price is $9, but there's a service fee of 15 cents in order to do this. So what you would gain would be $8.85. So there's a risk for price decreasing. Just make sure you understand the contract and all the risks that are involved in the event that prices do decrease. It's important to understand all those. So how do you put it all together? How do you have a plan? Do you have concrete actions or concrete action steps? How much will you sell when it's pre-plant? How much will you sell pre-harvest or post-harvest? In your marketing plan, are you going to look at it monthly, look at it weekly, try to be explicit? Are there conditions that are going to those sales? Do you have cash flow break-even points? Do you have storage? If you don't have any storage, what carry can you storage if you do? And that can get a little bit more complicated if you consider some storage costs as well. And is there a price target at which I sell more or less? Do we have that number in our minds? It's important to customize your plan. Identify those tools that you're comfortable using. I gave you several examples of how to figure out your cost of production. You can use that marketing matrix. There's information on FarmDoc Daily. I talked about the NASS data, the National Ag Statistics Service, that has a lot of historical information. If you're kind of new and haven't followed basis, you might kind of look at that, or that's local. You need to more follow locally, but trends, that has tons of information about trends, about when they go down and when it goes up, and those sorts of things. Also, what time commitment can you handle? Are you making 5 decisions or 50 decisions? Less selling points have shown to be just as effective as more selling points. So just because you might break your production up into maybe 500 bushel increments, we found that it's really no more effective than selling in several thousand at a time. And then what do you need to move grain if you have those storage options? Or sorry, when do you need to move the grain if you have the storage options? All comes into play. So just looking at a sample marketing plan for corn, we can kind of think about, we might divide it into fifths. We're going to identify a separate price objective and an associated strategy, increasing the risk profile for each successive marketing bundle in return for a more aggressive price objective. Let's see how that kind of turns out. So assume we have 500 acres of corn. It's going to be planted in the coming year. Yields have averaged about 200 bushels per acre over the last 5 years. So that's about $10,000 that we expect to produce. So kind of look at what that would look like from here. So if we're going to take the first 20% of production, so pre-harvest price, the first 20,000 bushels, when the market is offering a price of 20 cents per bushel above the variable cost of production, 20% or 20 cents above our costs. So this is going to be done regardless of the general market outlook. We're going to market that grain, get it off of our plate, so to speak. So this ensures that we're going to have a profit from the first marketing bundle. We already know that this price is going to cover our costs. So we're not worried, are we selling too early? We know that for 20% of our production, we're going to get our money back basically and make some at it. Some might not establish this price before February 1st. That's kind of up to you. Price objective for maybe the second 20% of production. So this is an example of what you might kind of put together in your plan. You might have a pre-harvest price that of 20% of your production when the price is in the top of its 1/3 of historical range. So this would be done regardless of whether the outlook looks good or not. So you're kind of committing to, when we get in that top third of historical range, we're going to sell another 20% of our production. Then we're going to look at maybe the next 20%, the third 20% of our production. So if prices are in, and this is what you would kind of literally kind of write out so that you can, keep yourself on track. If the prices are in the bottom third of the historical price range, we're going to speculate on higher prices. If they're in the middle third, we're going to put a price floor in to prevent falling into the bottom third. If prices are in the top third, we're going to place a price floor to remain in the top half of the historical range and look to establish something above about a price about 25 cents above the price objective for that's what we had in the second 20%. If there was no delivery commitment that's been made prior to harvest for our third 20% of production, potential post-harvest basis appreciation will be determined as kind of that signal for storing or selling at harvest. Might look at basis levels that are going to determine whether production is priced in a cash or a futures market. So if we have an attractive basis, we might put a price floor in to establish that minimum, and a flat price production will be through any forward cost contracts that we can get into. If basis is not so good, price floors are going to be established with a put option, what about puts, and flat price protection through a futures market. Futures market hedge, rather. Then in this sample, we look at, well, what about that fourth 20% of production? This part is going to be used to speculate on a season high prices relative to market outlook. And if prices are expected to improve, a price objective will be based upon what the outlook once it's been established. Then some provisions for if it's reached or if it's not reached. We're going to maybe reevaluate it, look at harvest and storage decisions. Then the final production, that's the fourth production. If the cash market at harvest is offering an attractive basis that looks more attractive over storage, then maybe half that bundle will be forward cash contracted for a post storage delivery, and the other half will be used to speculate on higher prices. But if the cash market is offering an attractive basis over storage, then the outlook is kind of flat or declining prices. Maybe the crop is going to be stored 100% for a forward cash contract the following year, usually. And that final 20%, we might say, okay, if a potential basis appreciation looks like storage is going to be the key, we're going to store about 2/3 of the with a price protection. If the outlook is high prices, we're going to store with a basis contract. If the outlook is flat or low, we're going to store with a forward cash contract. If basis appreciation is unlikely, but outlook is high, sell cash grain at harvest and replace with maybe a call option or sell it under a no price established contract. If basis appreciation is unlikely or an outlook is flat or declining, then you're going to sell that grain at harvest. So what's the result of the marketing plan we want? Well, we're going to hope that the first year sale of the year, that cost of production plus the 20 cents, we're going to hope that that's the worst sale that we made. In general, not more than 80% of the crop production is priced before harvest. Unless the prices are exceptional, it usually won't even be more than 60%. So make sure you're making an informed decision on storage, storage based on expected basis movement. That's what we're going to look at when we're going to think about storage. And probably don't speculate with more than 20 or 30% of your production would be ideal. With that very like fire hose of information, are there any questions on anything that I presented or other questions I didn't cover?
I'm gonna go ahead and stop recording here, and then we'll do the questions.
Okay.
Let me hit stop here real quick.